Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. It's earnings season, and we just heard from Exxon Mobil. We got another record quarter, even as oil prices have come down. I'm Jason Hall. This is The Smattering, and I've got the expert on Exxon Mobil here, Tyler Crow. He's going to help me talk about just how good this quarter was and our thoughts looking forward. Hey, Tyler.
Jason, I've got a bombastic headline for you right now.
Let's hear it. Let's hear it. I don't want to make a prediction.
Exxon Mobil hasn't looked this good in decades.
There you go. I thought you were going to make an obscure reference to a prior CEO of the company.
That's the B-side deep cut when we publish the after hours stuff.
Love it. All right. So here's the short version. I'll let you hit the high notes and actually talk through some of the numbers. But we saw in the first quarter of the year, calendar quarter, we saw oil prices come down and hit so far the lowest levels we've seen in the past year and a half, I think, at this point, well down from the $120 a barrel peak we saw in 2022. And to a certain extent, there were some expectations that maybe we would see ExxonMobil's profits start to ease down a little bit too. We saw that with Chevron, right? Their earnings came down a little bit. Chevron's dealing with higher oil inventory, but at lower realized prices. We saw that Chevron's refining business take a little bit of a hit, but we didn't see that at ExxonMobil. Tell me what you saw and what you liked the most.
Yeah, it's really when I start to dig into the minutia of it. It's an oil producer. Its earnings are going to wax and wane with oil prices to a certain degree. And like you said, there is some support from the downstream operations, which tend to work a little bit better in declining oil environments. And as a kind of a whole business, ExxonMobil has a much larger footprint in refining, chemical manufacturing, the non-production assets. And so it has a little bit more of that kind of earnings ballast than Chevron does. Chevron is a little bit more tied specifically to production. So, you're going to get a little bit more earnings volatility there. Obviously, earnings were down ever so slightly, like we said, because lower prices, but not that much. On a GAAP basis, they went from $12.75 billion in the fourth quarter of 2022 to $11.4 billion in this most recent quarter, despite the drop in earnings. And this is about double, a little more than double that it was in the first quarter of 2022. So we're still riding a very high number in terms of earnings. And the thing that is most impressive to me is doing this in large part because of the production that it's coming from is incredibly low cost and scaling up and becoming a huge factor for it very quickly. That's the Permian Basin and its shale operations in Texas. And then also this offshore production that they have in Guyana in South America. It's one of the most prolific finds of offshore oil that we have seen probably this century. It's cheap, it's easy to bring online, and ExxonMobil has been extremely good at doing it. And management noted that compared to this time last year, production from Guyana and from Permian Basin was up 40%. And it helped to offset a lot of declines from either divesting in older assets. You remember it had to walk away from a lot of Russian assets right around this time last year, and also just things eventually expiring. So because of all that offsetting and production in Guyana going up, it's been a huge change to the bottom line, and it's such a lower cost operation that it's just been a boom for the company. And as a result, cash flow is gushing. Its debt to capital is down to 4% on a net basis. It has $32 billion just sitting on the books, even after, what was it, $3-something billion in share repurchases this quarter on top of its dividends.
There you go. It's remarkable. And I want to highlight one thing you were talking about there and just really emphasize it. One of the things that you and I have been talking about over the years now is how much management's really been focused on sweating assets, the way you've described it, and really leveraging its vertical integration in a more holistic way versus just having all these disparate parts that say it's vertically integrated just because it owns the entire value stream, but they don't actually work together. It's made efforts to try to leverage that better and also sell off, again, things that were more expensive and didn't yield the same kind of return. So while seeing parts of its production fall off, the big thing to highlight again, especially with that Guyana asset that's going to be just such a cash cow going forward, even as oil prices have come down, it's been able to get really good cash returns because its production costs on the new oil reserves that it's now producing are lower than the costs on old production that it's divested of, even when oil prices were significantly higher. And that's a trend that is likely to continue to play out because we're going to see more of that older production fall off, higher cost production fall off, because it's still in the very early stage of developing Guyana.
You also have, like you said, when in terms of integrated things, there are other big pushes right now are liquefied natural gas terminals tied to huge natural gas finds, either Gulf of Mexico. They're looking at doing their big, I think it's Golden Pass LNG. So then you get to leverage your production in the Permian even better. Their Beaumont refinery in Texas, they're adding 250,000 barrels per day of production. Everywhere they're going, they're basically like, we're going to do strength on strength and take this and again, be a integrated company that gets the most return out of every molecule that we produce.